Good morning, ladies and gentlemen. Today we will start in a slightly different way, and that is by paying tribute to Chris Chavacco of Chavacco Capital Management, who has produced an excellent video, very didactic, and we would recommend that you go and watch this first so you can understand what we will be talking about in our own video. The address is here, YouTube. You go to the Chavacco Capital channel and watch this latest video. Thank you. Now let us have a look at what happened last week, and as always we start with the 2-year note. The 2-year note last week completely rejected the neutral to bullish area that we between 109.21 and 109.14. What the market is telling you is that the US economy is strong and that the odds of a rate cut are higher than the odds of a rate cut. I hope I got that right. Hike as opposed to cut. So the market has returned to pre-Brexit levels, has completely taken out 99% of the Brexit spike, and is now looking for further direction. The further direction is a question of whether this will flatten or steepen the yield curve, but what the 2-year note is telling you is that there is absolutely zero chance now of any kind of loosening of US monetary policy, but rather the market is looking at a potential tightening of policy over the next few months. And it's come back to trade in this very neutral range, where it's very difficult to get any signals from it. This can also be seen in the weekly charts. We can just put them, let's open it up. And the market has basically failed badly at this 200-week moving average, and it's coming back towards the equilibrium zone, where it just chops before it tries to make another decision. The 10-year note is actually a far more dangerous chart, because now we are in a position to make some major breaks, and what this market is telling us is that it is in extreme disequilibrium. It has failed at the bullish area, i.e. the flattening yield curve area, the immediate flattening of yield curve area, which we marked at 132.5, and even with this very quick spike on the news of the very late news of the Turkish coup, which probably will not be very significant in the greater scheme of things, it is telling us that the trend is very much down for the time being. This will be the crucial area, 131.03, 04, 05, which is where it came from at the Brexit break. We much prefer these lines that tell us yield levels as opposed to any kind of trend lines. We've found over the years that trend lines in 10-year notes and 30-year notes certainly don't work. What works is yield levels, whether the market rejects or accepts new yield ranges or yield levels. So to us, this area here becomes critical. Anything between 131.10 and 131.03. If that area were to break, then we will see a cascade of yields higher. We can show you that on the yield chart. On a weekly yield chart, and here you can actually see it much better. The level that we're talking about corresponds to this area around 1.65, where the previous lows were, and these lows for these weeks were. So what we're saying, if it starts going through 165, it'll certainly go to 190, and it might even go to 2%. So we could have a very big move in 10-year notes over the next few weeks. If it, on the other hand, gets caught by these levels, we will most probably try and go and make new lows in terms of yield. That is why we're saying that that area that we brought up for you, the 131.10 to 131.03, is going to be extremely important and pivotal. Mark it down, and it will actually decide the course of the next few weeks worth of trading. Exactly the same thing can be seen in the European markets. This is the Bund. If we break the 165.50-60 area, we will have another cascade probably to 164.60, and if we would break 164.60, things start getting pretty hairy, and we could have a massive move down all the way to at least 161. So the pieces are falling together. Either the 10-year note holds the in the next 3/4 of a point, and the Bund holds the 165.60 area, or we are heading to much higher yields. That can be also seen in the Bund weekly yield chart. If we don't hold these levels, i.e. 0.5, we are definitely gonna go to 32. These are massive moves for markets which have been doing nothing but go down and down and down in yield. So we are approaching an extreme level of disequilibrium here. On the other hand, if the Bund holds this 3 to 7 area, it's going to go straight back through the lows in our views, because it cannot just hold here. This is disequilibrium, not equilibrium, and therefore we think that volatility in the fixed income markets is going to rise substantially over the course of the next few weeks. Now, why is volatility in the fixed income markets especially going to start to get quite radical, we feel? Well, Japanese monetary policy could be about to get really radical. Radical monetary policies elicit radical rate moves. The Bank of Japan will, on July 28th, hold a meeting, and the decision will be announced on July the 29th, which is a Friday, end of the month. That's going to be extremely important for all asset classes, from equities to fixed income and foreign exchange. Let us have a look at the biggest canary in the coal mine, in fact the one that is not doing anything, which is extremely surprising: the dollar index. It is now basically still 3% lower than it was at the beginning of the year. We would expect that this contract will show us the way out of this disequilibrium. it is now, this can be seen much better on the daily charts, at the 96.5 level, which we marked many weeks ago, right here, so several months ago, as being the pivot point for the year. And it's a level which has been, when broken significantly, has led to massive several percentage point moves. Now, why do we say that? We say that because the only economy in this world which seems to be functioning, and where we're getting some stronger data, is the US economy. We're getting quite strong retail sales, we are getting quite strong employment data on average, and yet the dollar cannot even get back to the levels where it was at the beginning of the year. The UK economy is weakening substantially. The EU economy is as weak as it ever was. There are huge problems with the banking system in peripheral Europe, if not in Europe as a whole. And yet the dollar doesn't move. The dollar, on the other hand, is the only contract which has not retraced any of its post-Brexit jumps. So it is going to be very interesting to see what the dollar index does in the next week or so. It is as well at a point of complete and utter disequilibrium. So the 10-year note is approaching disequilibrium levels, the Bund is approaching disequilibrium levels, and the dollar index is at a incredibly important inflection point for the year. Either it's going to make a massive move higher, or if it fails here, these levels here are not going to hold it. It's going to go straight back into this channel and probably trade much lower. What is going to be the deciding factor and the catalyst for these moves? Well, we have no idea. We just know that price is at a disequilibrium point, and that is all we need to know to be able to formulate strategies. As traders, we are not really trying to predict price as opposed to react to prices and what they are doing. The disequilibrium can be seen in this chart of dollar yen. It's a daily chart. The anticipation of monetary easing has pushed the yen all the way to the top of the daily Bollinger Bands, and on Friday it started reacting against it. We would not be surprised to see another fall. That's what we are banking on, into around 103.10, 103.30, and that will be the inflection point which decides the next move. Either it is going to make a massive move higher and probably touch these 200-day moving averages, which are around the 114 level, i.e. go straight back into that channel in which it traded for nearly 2 months, or we will try and make new lows. So even this chart, which is so pivotal for many asset classes, is telling us that extreme disequilibrium is approaching and big moves are afoot. Let us start the review of the equities asset class with a contract which really we missed out on last week, to our great chagrin. The Nikkei had a massive week. It rallied best part of 9% in a week, which is a massive move, and that too is showing us that it is coming to extremely important inflection points. These parallel lines with this slope seem to be catching the moves in the Nikkei extremely well. And we have a very important pivot point just below the 15,000 level at 14,700, let's call it. And it's caught all these lows, and basically the market cannot go below it. And we also have the 200-week moving average still sloping upwards, holding it up. Well, this is telling us that this market, if it now does not continue higher, and breaks this 14,600, it is going to go quite a bit lower, probably to below 14,000, but could go all the way back down to 10,000. On the other hand, if this is a swing low, it's going to go and try and make new highs for sure above the 21,000, 22,000 level. These are massive moves which are going to happen within the next 3 to 6 months. Let's have a look at what could bring those moves about. Well, what could bring these moves about is the state of the only remotely functioning economy in the world, which is the US. You'll remember last week that we tweeted, this is a chart of the cash, so it's off but by about 7 to 8 points with ES, that we tweeted that we were through the weekly Bollinger Bands. Going through the weekly Bollinger Bands and closing above the weekly Bollinger Bands is a rarish event in the US market. It doesn't happen very often. Sometimes it's marginal, it closes slightly through it by, I don't know, 0.25% or something, and next week it comes back to the Bollinger Bands, and then either holds it and goes substantially higher, or it doesn't hold it and goes back to the moving averages at the very least, if not to the bottom of the Bollinger Band. Many examples of that throughout history. If you remember, we said in the previous video that if we are now in wave 5 tends to resemble wave 1, and you get this kind of behavior where it spikes the Bollinger Band, comes slightly back towards it, and then makes the next move upwards. But there are many better examples. Better examples tend to be on the failure side, tend to be this, which happened in 98, where you have a spike higher of the Bollinger Bands and then a complete breakdown the next week because it doesn't hold the bottom of the previous week or the Bollinger Band level itself, and it comes back to the very least to the moving average and then tries again. It's very rare that you have successful breaks of the Bollinger Bands. Now, if you are looking for examples, some of the best examples were in the 70s and 80s, where the market broke a multi-year range, like here between 83 and 85, which is what we are having, spikes the Bollinger Band, and then cannot get back, and every day, every week, because these are weekly charts, it keeps on going up. That is the danger that we are facing. One of the better examples is back in 75. You can see that these moves are actually massive moves, because the market went from 77 to 96. I mean, that's a 25% move, right? Every time the Bollinger Bands have been spiked on the upside, and the market has been unable to reclaim lower than the spike of the Bollinger Bands or lower than the previous week, the resulting moves in percentage terms have been extremely high. we're talking in the order of magnitude, certainly approaching double digits, if not straight through it. And this is actually exactly what happened in 87. You have this area consolidation, a move above the Bollinger Band, never came back, just kept on going for a 10% move. The retracement was 2 or 3%, another 10% move. So what we are saying is that we are in another market at an extreme level of disequilibrium. This market will either make a 10+% move higher, or it will fail and come back substantially. These technicals, this spiking of the Bollinger Bands, actually makes fundamental sense if you think about what is happening in the market, the internal dynamics. We have a market which is making new all-time highs, having broken a multi-year range, and people are frantically chasing the break because they need to be invested. They cannot possibly afford to have underperformance, continued underperformance in their funds. So either the market will prove them right and the range expansions will continue, and one should never fight range expansion because it can be a very, very powerful trend. Therefore, fortunately, we have instruments which enable us to profit from both a continued 10% move or a complete breakdown at these levels, which continues down towards at least the moving average, which is around let's call it 2100 next week, and possibly all the way back down to 2000, having rejected these upper levels. As traders, we don't know what is going to happen. We have our preferences. We have what we consider is the more likely outcome, but we just don't know. And if we can profit in either direction, we should certainly do so. Let me tell you what I think is going to happen. I think the move is going to continue. I think we are in wave 5, and I think the market is, in fact, the central banks have managed to turn the world on its head. We have managed to get a bottom at a top. This should have been a long-term top for at least a retrace back towards this kind of level, 1500, 1600, with many months of churn around this level before we decided on the next move, whether the leg up or leg down. The fact remains that the US economy is slightly stronger than the other economies in the world. The fact remains that the liquidity is absolutely humongous. The fact remains that bond yields are relatively low. Whether they now rise or not, they're still low. And the central banks keep on intervening and keep on threatening to intervene on any pullback. Therefore, people just are buying the pullback every time it happens, BTD. Therefore, personally, I think the market continues, but that doesn't mean that we can't profit from either a move up or a move down. What are the fundamentals saying? Well, we are now through the 17 times valuation, future forward earnings valuation, which has never successfully been broken, never successfully in the history of the S&P contract. It's been successfully broken in the Nasdaq many times, but not in the history of the S&P. Does this mean that the market can't go substantially higher? No, it certainly does not mean that. It just means that either the economy will now accelerate and these future earnings will start accelerating with it, the slope of them going quite positive as it is in 2009, 10 and 11, or we could get multiple expansion. But what it does say is that we are at extreme, or will get to extreme levels of valuation, which are extremely dangerous, i.e. another disequilibrium point. So you have all the technicals and all the fundamentals telling you that the market is at a disequilibrium. When markets get to disequilibriums, moves tend to be large and violent. Therefore, we are in a position where we feel that actually having experience of the markets is probably a disadvantage in terms of picking directions and doing outright trades. Why? Because since we've been trading, and that's the very early 1980s, we have never seen these levels of valuation in the markets. We've seen them in the dot-com boom, in a different sub-asset class of equities, but you can just ignore that. You just don't trade it. You just go away. You don't trade the Nasdaq. You don't look at it. Who cares? It certainly influences the S&Ps a little bit, but it doesn't affect the valuation of Kellogg's. So basically you can concentrate on what you like doing, but here it's becoming increasingly impossible to walk away from the pockets of extreme valuation, because the whole market, everything is becoming ridiculously valued. So we feel that our experience is actually a disadvantage to trading these markets consistently here. Consumer discretionary as a sector has still the ability to go substantially higher. Consumer staples to us are a huge sell. The energy sector is still a huge avoid, because it's going to take years for this to normalize itself and come back, and there'll be huge volatility up and down. So we would avoid it. The financials are beginning to turn up. Maybe the financials is the area to be in. We are not so sure, but there you go. We will allow for that possibility. We certainly see the possibility that the financials will trade around the 330 area, which is another 7-8% higher than they are at the moment. Healthcare to us is still, although it might suffer some pullbacks, the one area that can have substantial growth, because if it goes to 18 times valuation like it was in 2014, you're talking about a substantial move, 15% or so. The same can be said for the industrials. The industrials now could quite easily make a 10% move higher. Technology could make a 10% move higher without too much difficulty. Materials could make a 5, 6, 7% move higher without too much difficulty. Telecommunications could easily make a 10% move. While the utilities, we find it hard to believe that they can. But given the fundamental look of the sectors, it is quite easy to see that overvaluation could continue for the foreseeable future, with big moves higher and or lower. Having identified that we are at disequilibrium levels in just about every asset class, the dollar index, equities, and interest rates, we are utterly amazed by how low volatility is, and therefore we plan on taking advantage of the low volatility. If you have a look at where the 1 week puts and calls settled on Friday, you will see that you can buy, let's say the market settled at 2150, you can buy the whole week's protection on the downside for less than 9 points. To us, that is extremely good value. We would much rather give up the uh, the 8 or 9 points on the downside and be protected than just be blindly long, because we feel that you could have considerable downdrafts in the market at any time, and therefore having short-term options as protection is very attractive to us. So our strategy for the next week in all asset classes is going to be to buy protection against anything we do. So if we go long 100 at 100 contracts of the of ES, we will be buying the equivalent amount of contracts in puts underneath it. 2140 puts, for example, 2140, 2135 are going to be extremely important levels next week. And if you can buy those for less than 6 points, one should certainly do so. If we can buy the contract at 2150 and the 2140 puts for 5 points, well, then we know that our maximum downside is for the whole week is 15 points. That is nothing. If the market now catches a bid, it could easily go up 30 points, 40 points, and if we give up 5 points on that move, well, so be it. What we're saying is that the risk reward of playing the outrights as opposed to the options now at this level of volatility that the market is offering is completely ridiculous. We will be shifting all our trading towards the options, and we will be leaving the outrights alone. We've identified that the minimum amount of move from here is going to be in the order of 5 to 10%, whether upside or downside. Now, this option expires in over a month's time, and we have the 2140 puts offered for 30 points, just below 29.5 points. That to us is extremely attractive. Being able to be long of the market and knowing that all you can lose really is 30 points for the next month and a half is extremely attractive, and we'll be shifting all our attention and all our resources to buying longer term options or buying short term options against our outrights. Those are much better risk reward trades than being blindly long and risking being stopped out in one of these downdrafts. What are we going to be doing as soon as the market opens today at 6 p.m. New York time? Well, we will be buying S&P calls. We're hoping the market opens lower, and we will definitely buy S&P calls because we don't think this Turkish thing is very important in the long term. We will also be selling or rather buying puts in 10-year notes and buying calls in the dollar. Those are going to be our first trades for the week, and we should certainly tweet whatever we do. Unfortunately, the market in options at that time is quite thin and wide, so we might be forced to wait until it gets a bit more deeper and the spreads get tighter, but we shall certainly tweet what we do, and be warned that most of what we will be doing for the next couple of weeks will be in options as opposed to outrights. It makes fundamental sense, it makes risk reward sense, it makes P&L sense. We don't know which way prices are going to move, but we know that we are at a disequilibrium in all asset classes, and we want to be able to take advantage of that disequilibrium either way it goes. Thank you.